Hi, my name is Simon Misiewicz from Optimised Accountants, and I'm here to help you reduce your tax liability. Now, in this video, I'm going to be talking about 17 ideas. And to be honest, I am sure by the time we have finished with this video, I would have helped you identify 20 property tax saving ideas that you can take forward, not just today, but for the future as well. So let's get into that detail. Before we talk about this tax saving ideas, I have created another video which is appearing just above my head right now and below this video description, where it talks about how people overpay tax liabilities on their property tax return. So do go check out that video. I was quite animated in that video, so even if for a kind of entertainment value, do watch that video, because that's it will give you some ideas where people pay tax and where I get a little too animated. If you want to know how to save tax on your business or your investments, then don't forget we have got an online community where you can get a 7-day free trial. I am live every Wednesday to answer your tax questions, whether it's to do with your business or indeed any type of investments that you're making. We've got a bunch of videos on there, hundreds of videos, in fact. Excel templates to help you reduce your tax liability. So why not learn today, save tax tomorrow, and make sure that you take advantage of the 7-day free trial, and I'll see you this Wednesday. Now let's talk about property income. The more income you have, the more tax you pay. So it's really important to understand what your tax is and what your income is. And the one thing I would say to people is make sure that there's a couple of things here. Okay, I apologize in advance because I'm going to go on a rant. The property investments is a business. And if you are going to act professionally, if you are going to be taking advantage of your business to make as much wealth as possible, you've got to start looking at your financials on a monthly, if not quarterly basis. If you are trying to lose weight, you don't ignore the amount of calories you're consuming. You don't ignore the weighing scales. You are religiously looking at those things. So what about your property business? Now, if you're using tools, which I really appreciate using Xero. I know people like using QuickBooks as well. I'm not a fan of QuickBooks, I've got to be honest, compared to Xero. QuickBooks is very clunky, I've got to be honest with you. Xero is very streamlined. But ultimately, whichever software you decide to use, it will help you understand your income and costs. And it is a business, and therefore greater accuracy equals greater focus on profits. If you want to sweat your assets to generate as much income, then keeping an eye on all of your income, all of your costs, so that you know how much profit you're going to be making, I guarantee that you'll make more profit than those people who are just passive in regards to their investments. And there's a lot of people out there that just talk about, the great deal. And then the deal comes on the table, then they get their property under the belt, they tenant it, but then they don't look after the income, they don't look after the costs, and then they worry about, well, I'm not making much money from property. Property is a bit of a scam. No, property is not a scam. Property is a great way of making money, but you have to take more responsibility of your finances. And using Xero and QuickBooks will help you do that. Okay, rant over. Let's move on. So the thing about the income, you can use something called the cash basis. Now, the cash basis says you will only pay tax on the money you actually receive. Now, there are some systems out there that will base the financials on accruals basis. So you could say, especially in QuickBooks or Xero, that it will say, right, okay, put the AST on the system, and it will correctly, by the way, put your rental income for 12 months in the system, which, for all accounts, you may not have received that money. So from a tax perspective, the accruals basis where it's automatically doing this for you isn't so great, because now you're paying tax on money you have not received. And it is totally possible that you, as a taxpayer, have paid tax on income you may never receive. So really, you've got to be on top of your finances. So how much tax have you paid on your income that you've not received? Maybe some suggestions in the comments box would be really useful. People that are doing property and they've got the first property, they may be in that transition year whereby they haven't got all of the property income for that property. They may have only owned it for 2-3 months. If that's the case, then the gross income on that property may be less than £1,000, especially if it's owned between husband, wife, civil partners. Then ultimately you could have £2,000 worth of property income, gross by the way, that does not have to go on your tax return. Well, it needs to go on your tax return, but you get this property income allowance, which basically means you put that number in, it's acting as cost, therefore you don't have to pay tax on it, and you don't then have to put all the other costs in it either. How many people look at these notes when they're doing the tax return, especially when they're doing the tax return on the 31st of January? Are you getting embarrassed here? Are you feeling warm around the collar? 31st of January, 8 o'clock at night. Oh, I've got to get my tax return in. I ain't got time to look at these notes. Oh, I've paid my tax than I should have done. Mistake, right? So the thing is about tax returns, and this is probably tax tip number 20 by the time I finish this, is focus on your tax return nice and early, because it'll be fresh in your minds. If you do your tax return in April, May, June, as opposed to January the 31st at 8 o'clock at night, you will remember a lot more about the property journey, which was now, well, let's be fair, 8 months ago. So you really got to get on top of your numbers. And if you've got less than 1,000, make sure you read these notes. Make sure you don't pay tax on this gross income of £1,000 or less. The other side to it is, I love this one, repairs. Repairs is such an easy cost to get some tax advantages on. I'm going to talk to you about so the BMV stands for below market value. So you might buy a property for an old couple that is going to a care home, as an example. Now, you know full well that they've got salmon or green decor throughout the property. And they got the old rickety wooden finished kitchen. They have got the green or the salmon coloured bathroom suites. God awful. But they've got them there, and you know full well you are going to replace those items. Now, you might negotiate the price down because you're saying to them, well, the house price is £200,000, but clearly there is a lot of work that needs to be done in the house. I estimate it, on my experience, it's going to cost me £15,000. That £15,000 really has got to come off the purchase price. So let's do a deal for £185,000. A great way to do it. By the way, if you do that kind of negotiation, then you could also save stamp duty, land tax as well. So another good reason to do some negotiation. But the reason why I mention this is if you are then replacing that kitchen, replacing that bathroom, that will be a legitimate replacement cost. And as a result of that, you can get tax relief on that £15,000 as an example I gave you earlier. So, and those losses, by the way, can be then carried forward, which I'm going to talk about later on, for indefinite until they've been used up. So why not do that? Now, the bit on the bottom, interesting enough, came up from a recent tax call I've had with someone where I said, well, stick all these repair costs against your tax return to pay less tax. And there has to be a decision here, because you may want to use your tax return in the form of evidence to lenders to say, hey, I'm mortgageable, give me a mortgage. But if you are demonstrating constantly that you're tax efficient, like I was, for 8 years, I paid no property tax. Now, I was gloating in that for a long period of time until I needed a mortgage to buy a house. And I couldn't do it. I had to wait 2 years to get a home mortgage on a property that I really wanted because I was too tax efficient. So you do need to weigh up. This could apply not just to home mortgages, but it could also apply for buy-to-let mortgages going forwards as well. If mortgage lenders are looking at you as a business and you're making losses all the time, then they may not take you that seriously and push up the interest rates, or even worse still, not lend to you at all. So do be a bit careful about being tax efficient against getting a mortgage. Loan interest and other finance costs. So this is about putting the right amount of mortgage interest costs correctly in your tax return. The thing about this is that people will say, well, this is zero. Accountants may put zero, but you need to really look at, well, do I have some furnished holiday lets in here? Do I have some commercial properties? Well, some of those costs mortgage interest costs for commercial properties and indeed furnished holiday lets would be allowed. So you can put those costs against your tax return. You can get the full tax relief on those costs. So please do make sure that you don't just put things in a spreadsheet and go, right, yeah, it's all on property income, and you've got mixed portfolio, because you could be missing out on the opportunities to get that tax relief. So what I would do personally is segment your property by property on a column by column basis on your spreadsheet. Make sure that it's identifiable to say, does section 24 affect this property? If it does, then fine. Don't claim the tax relief in this box on your tax return. If you've got commercial properties, furnished holiday lets, make sure you put that mortgage interest cost against your tax return and save tax. Too little cost in tax return equals too much tax, and that's what we're trying to avoid. So make sure that you really are clear about the property, the type of property, and indeed with the mortgage interest cost that you can or cannot offset. Other capital allowances. Now, there are capital allowances on commercial buildings and indeed furnished holiday lets. Now, residential properties you can't really get capital allowances on. Used to, but not so much now. But furnished holiday lets and commercial properties, you can still get capital allowances. You may also have furniture and office, purpose-built office in your home, and the furniture that you've purchased for your business could well be claimed against your tax return. So again, if you've got these kind of furnished holiday lets, make sure you use a company like Six Forward, who are capital allowances specialists. They will come out, do a survey on your property, identify the capital allowances, and then say, put this against your tax return. They will be able to identify far more capital allowances than you can. And indeed, I would argue, far more than your accountant. And the reason for that is because they will do a survey and look at things that you cannot see. So you can easily see in your furnished holiday let, the furniture, the TV stand, the dining suite, the beds, that kind of furniture. You can see that. But what's Six Forward, which is a capital allowances specialist, what they could do is look beyond the walls. X-ray vision. So now they can use their X-ray vision to go through the walls and see pipes. They've got the pipes for the water, taken through the systems. You've got the gas pipes, and you've also got wiring for electrics. They can claim those on the capital allowances claim, which means more cost, less tax. Brilliant. How many people do that? It'd be interesting. Maybe drop a comment if you claim capital allowances and it's helped you to save tax, just so you can provide other people with your insights. Cost of replacing domestic items. Again, here we may have a scenario whereby you have got a property. Talks about domestic items. You might have furniture that you've bought from someone, and you've got some, a dining table that the old couple have left behind in the previous example. They might have left the beds because they only need 2 beds and they had 3. Would you mind skipping that for me? Yeah, you're a nice person, you'll do that. If you've got HMO, for instance, you might replace that bed because who wants to sleep in that? And then you get a new bed. You've got a new bed, and that means that it's a replacement item. So that can be claimed on your tax return. Indeed, you may have fridges and freezers that have been left in that property. But again, if you replace those items, skip the first ones, then those items can also be claimed against. So make sure you do that. Not only that, but did you know, there's a question for you here, did you know that the stamp duty land tax is based on the bricks and mortar, not the contents of the house? So if you turned a house upside down and give it a good old shake, you would be a strong person and you should be on a show. But aside from that show, if you tilt a house upside down and furniture comes down like that, then those items are called chattels, and you do not pay stamp duty land tax on chattels. So you can turn your house upside down, anything that goes to the floor, place a value by going around with the seller and say, well, how much are those curtains when you bought them? value. How much will those curtains? Value. Furniture? Value. And at the end, you will come up with a value, let's say £3,000. You go to your solicitor and they go to their solicitor and say, well, we're doing the house for, I don't know, £200,000, less the furniture of £3,000. You've now just saved yourself 3% SDLT hire rate on that £3,000 because they are chattels. You'd also save on stamp duty land tax banded rate. But currently, we're in the SDLT banded rate holiday period, are we not? Now, if you're watching this video after the 1st of April 2021, you're probably thinking, what's this guy talking about? But nevertheless, you will be able to save stamp duty land tax on chattels, and you need it documenting by both their solicitor and your solicitor to make sure you don't pay too much. Other allowable property costs. Now, if you are looking at your expenses, maybe using your mobile phone and claim for mileage, put this on your dashboard. It will be great to help you clock the mileage that you're doing for your business, and you get 45 pence per mile done to offset against your property income. After the first 10,000 miles, it will go down to 25 pence per mile, but still, it's a nice tax relief. If the fact you've got food that you pay because you're traveling out and about, seeing letting agent, estate agent, make sure you keep that receipt because you can claim a certain amount against your tax liability. How many people are doing that? There are so many other costs that you can claim. Use of home furniture costs. Home furniture costs, I did this on my previous video, I didn't correct it here. What I mean by home furniture costs is not your 72 LCD TV or your Omega TV or whatever it is. You can't claim home furniture. It's to do with home office furniture. Okay, so you've got home office furniture. You can claim that on your tax return. And here we got the residential finance costs not included. You remember when I said earlier, mortgage interest costs will not be allowed going forward on residential properties. You can claim that mortgage interest cost for furnished holiday lets and commercial properties. We know that. You can get the tax relief on those items. But residential properties going forward, no. All of the finance costs associated with the residential costs would go into this box right here on your tax return. Now, you still get 20% tax relief on those mortgage interest costs against your residential properties. I have heard several times now people that are submitting or have submitted their tax return and left that blank because they didn't know what it really meant. And they thought that tax relief, Section 24, means you can't get any tax relief, so they just left it. Make sure that you get a spreadsheet that helps you work this tax return out. The online version of HMRC's tax return will not do that for you. If you're using an accountant, they will use commercial software and it will do all these checks for you. So you know full well that they're benefiting from software, which is not humans. Humans make mistakes, okay? That's just the way it is. Can't kick people from making mistakes. Well, you can, but it doesn't really solve anything. So ultimately, you do need to be aware that you can claim these costs. And losses brought forward. Again, this just says about FHL, but this really does apply for property income generally as well. So if you have got losses in prior year, make sure you do the brought forward balances. Again, the HMRC software for tax returns may not do this for you. In fact, it's pretty manual. So you have to enter it. And people do forget to put their losses from previous years. So remember I said earlier, whereby you've got this £15,000 worth of refurb costs. If you had £3,000 worth of profits, well, now you've got £12,000 losses to carry forward, which means you do not pay tax. But that £12,000 worth of losses needs to be put into your tax return so then any future profits can be offset against it. It is potentially like my position before, where I paid no tax at all in 8 years, simply because I was buying one property and then the next year I would at least buy one, if not two properties, and then repeat that process of allowable costs for replacement, repairs and renewals. All 100% tax allowable, all legal, and it helps you save your tax. That brings me to a close on that section. So if you want to discuss our services to help you with your property tax return, make sure you do it before our closure date is 30th of October. So probably very short now. But if you want to review your tax or your tax structure for your business or your investments, then don't forget to book a tax consultation with us. Then you can use the code YouTube25 to book your tax consultation with that 25% discount. So have you done your tax return? How was it painful, by the way? Was it easy? Did you get the most tax reliefs? Has this video helped you to identify more tax breaks? Then do let me know. That would be great to hear your stories. Make sure you like this video if it's been helpful. If you're watching it all the way till now, it should be useful. So please do give it a like. And don't forget to press subscribe so I notify you every time that a new video will be released. Until next time, my name is Simon Misiewicz from Optimize Accountants. I'll see you again very soon.